Joining us now to talk more about the next set of decisions facing the Fed, Roger Ferguson is here, former vice chairman of the Federal Reserve, former CEO of TIAA, and a CNBC contributor. And it's great to see you in person here in Aspen.
Thanks, Andrew. Nice to be with you.
It's nice to be with you. I'm so curious. He says early 2024. What do you think? Is the cash going to run out? Are we going to get into a recession?
Well, you know that I have said for quite a while that I thought a recession was more likely than not, for exactly the reason that he suggested, which is that the Fed is fighting a pretty entrenched inflation right now. And so the possibility of recession, I think, is still there. And early 2024 seems like it's a reasonable possibility.
There's a lot of debate around here about this piece of it, but also whether Jay Powell is going to actually go farther, meaning there's the 2 rate increases that seem to be set on the table. At least that's the conventional wisdom. I think, are you in the camp of there's more coming even beyond that?
I'm certainly in that camp. And the reason is that inflation is really quite intractable. And they've been very clear about getting it down to the 2%. And so I think facing that kind of inflationary pressure forces them to keep going until they are clearly convinced that inflation is on a downward trajectory. And that might take them to 3 rate hikes, possibly more, if the data call for it.
So you think there's 3 rate hikes in this calendar year?
I think there are 3 rate hikes this calendar year, early next. So trying to call the year is really less important than where the terminal rate's going to be. And I think the market is once again perhaps off just a bit by being a little optimistic the Fed's going to be done perhaps before the Fed itself is ready to call all clear.
Here's a somewhat political question. We've been talking about Bidenomics all morning. Heather Boucher was on the broadcast. She was actually here in Aspen just yesterday or the day before. Are you of the view that what's happening in terms of the inflationary story in this country has been a function of the Federal Reserve being, frankly, behind the curve? Or are you of the view, or how much of you are the view that the inflation that we have seen, at least even on the margins, was a function of some of the stimulus and other industrial programs that this administration put forth?
Look, I think it's fair to say when you get this kind of inflationary pressure, recognize 2 things. One, it's global, so the Biden administration is right there. Some that had to do with geopolitics, energy, food, et cetera. And yes, I think in this country, the Fed was a little bit behind as it got into the transitory debate. And certainly the modeling would say the amount of stimulus that was put in was deeper than the hole that was left because of COVID.
But how much is that? We were talking about this Greg Ip piece in the Journal this morning. How much do you think of the inflation we saw was a function of what the administration put forth in terms of the stimulus? And is it just because that's part of this? That's part of the political argument that's happening in the country, because you can look at a lot of the numbers from the administration, which are very good on jobs and the like, and so much of that. But at the same time, if you're not feeling it, which is to say in your pocket in terms of wages, you say to yourself, maybe it isn't working.
Well, look, the answer is unfortunately both are true, right? So I saw earlier in your show there was a discussion about a big factory that's going up in I think New York. Clearly a sign, as always expected, that this is an investment-driven kind of spending that they're doing, and that's going to take years to play out. So the challenge, I think, for the administration is they are looking at the supply side. They're saying we need more chips here, we need better infrastructure. All of that takes years to unfold. It does not feel to the consumer as though their actual real wages are going up because inflation is high. So it's a really tricky dilemma for them. To answer your earlier question, I would argue inflation tends to be, first and foremost, a monetary phenomenon, i.e. the Fed being late. I put some of the blame, fair amount of the blame there. Global pressures that got out of hand. And then for me, in third place would be the stimulus package. Not that it was irrelevant. And I would say what they're trying to do is drive towards supply, which over the longer term will really pay off. So I think they will have a pretty strong argument to fight that what they're doing is going to make America better over a period of time, not necessarily quarter to quarter.
I have a CEO operational question for you, which is the other conversation that's happened here a lot in the past couple of days is around ESG. And for many, many years, you'd come to a place like the Aspen Ideas Festival, and people would talk about ESG very actively and very positively. And I would say you've seen a real switch in the past year. Even Larry Fink, who was a real pioneer on this very issue, seemed to be, I don't want to say stepping back from it, but trying to take it out of the vernacular, if you will. So what do you make of that?
What I make of it is there's real political pressure, right? People have seen what has happened in a number of states, Florida, Texas, others, where, in fact, the governors and the state legislatures are going after those that are investing with an ESG lens. I think it is important to recognize that ESG are different kinds of risk factors. I think investment managers, CEOs, et cetera, should put that on their portfolio of risks that they're analyzing. They may want to step back from it a little bit politically, but I think when it comes to thinking about where you put your money, how you run your company, ESG factors should play in and be really thought about.
Here's the question. So I was talking to a hedge fund manager who's here last night, and he said, you know, in Europe, all of the sovereign wealth funds and others say, you know, what are the ESG factors that you're using? And we have to tell them we're doing this, and this, and this, and this. Then we're here in the U.S., and we're meeting with pension folks in Texas, and they say, do you look at ESG? And we have to pretend as if we don't do that, and we have to say something else. And so we're creating this very unique sort of moment.
Absolutely. And so I think the job is to be, one, be as honest as you can. But two, I think for those who are skeptical, you have to simply say to them, it is part of our risk portfolio. We want to get paid if we're taking ESG risk. And there's probably some risks that we don't want to take. Now, part of the issue here is also about sort of the energy transition. I also think if you're running a large pension fund or running a company, you have to recognize that hydrocarbons are part of the economy, and you can't completely disconnect from that. So it's a tightrope, but I think recognizing this as this is a risk that you should be paid for is important, because we've seen what happens if poor governance exists. We've seen what happens if companies don't take environmental impact into question, into their consideration. So I think it's important to keep all of it going.